credit analyst at CFC Seymour, and Ben Pedley is investment strategist at LGT Bank in Liechtenstein, who is our guest host. Gong Liang, thank you very much for joining us today. We've been watching what's happening in the equities markets. How is the panic and the risk aversion manifesting itself in the Asian debt markets today?
I think this time the sell-off is triggered by the freeze of 3 BNP funds, which results in a further concern of subprime crisis. And you can see a jump in the 3-month LIBOR to 5.5% means that investors really sought to the safety of the cash to avoid the subprime contingent sell-off. But I don't think it's a kind of a fundamental sell-off or a technical sell-off. It's more than a sentimental volatility, because the main reason is that the CDS and the CDO, the pricing of that is not so transparent, so the investors cannot really sense the quality of the fundamentals and the ratings, so they have to sell it to go to more safety of the cash. I think the widening of the credit spread is going on until the liquidity and the market sentiment has been pieced by the more transparent information of the quality of the CDOs and the CDS in a global market.
Hi, look, it's Ben Pedley here from LGT. I guess if you're an investor and you're watching, that's all very interesting to talk about the credit default spreads blowing out, which of course they have done in the US, Europe, and of course here in Asia. But I mean, credit default swaps are obviously an insight into the creditworthiness of whatever the underlying bond is. And what I'm asking you is that if you're a holder of, as a lot of private bank clients are around the region, if you're holding Indonesian or Philippine debt, are you worried? Do you sell, or do you hang on because you think basically that this is going to be a temporary phenomenon?
Currently, I will sell some profitable bond, which did quite well before February in 2007, because at that time the spread was really tight. It is beyond the fundamentals. Now I think the Asian high yield bond, the T spread and Z spread, especially for the China high yield bond, has been back to the levels to well-priced fundamentals. So I will do some reposition to sell some profitable bond, or even the single B or something like that. I will keep the triple B and maybe some part of double B bonds, because the fundamentals there are still strong. The leverage is not so high for that company.
Sure.
So I will do some reposition. Yeah.
Okay, but probably not the time to buy, right? I mean, if you're looking for value, it's too early to look for some value out there in Asian credits.
The value of Asian credit, it all depends what kind of countries. I think for China, I'm still bullish about that, because the fundamentals is a little bit isolated from the global markets. But for Vietnam, because I mainly cover the mainland China, Greater China area, I'm not so sure about the Malaysia or Indonesia bonds. But fundamentally, I will keep an eye on it. I don't want to buy or to do the reposition in that area, because they will be impacted more than the Chinese high yield bond.
Okay, thanks very much for that. We'll get back to you in just a second. Gong Liang is credit analyst at CFC Seymour, and Ben Pedley from LGT Bank of Liechtenstein is staying with us here on set. We're just going to let's get back to our guests. We have Gong Liang, credit analyst at CFC Seymour, and Ben Pedley is investment strategist at LGT Bank in Liechtenstein, and also our guest host for the 2 hours of the show. Let me get back to you, Gong Liang, because obviously there's still a lot of uncertainty in the markets right now, but nonetheless, one of the fears that is out there is that if we see a protracted slump in the global stock markets, it could lead to lower economic growth around the world, which in turn might mean that central banks around the world are either not able to further raise their rates, or might even have to switch to even more accommodative policy stances. In other words, cut rates. If that is the case, and I'd like to know whether that is something that you think is possible, how might bonds perform?
I think the bond has underperformed compared to the equity in this kind of sell-off, unlike the sell-off in February, And I think the current bond to some sectors a little bit discounted. And I think it's a good time to do the reposition to sell some profitable bond, which cannot be supported by the fundamentals. I think the slowing down of the global economy will not be triggered only by this event, but will be be triggered by some potential rate hikes and the concerns of the overheated market and how to curb the liquidity. It's all due to the other factors. Otherwise, I think the bond market has underperformed the stock market in that sector. The stock market will rally soon to support the liquidity of the whole market injected by ECB and the Fed.
What about renminbi-denominated bonds issued into the Hong Kong market by some of the Chinese mainland banking institutions? Would you also be steering clear of those? I mean, I know we had some strong reports out this morning, for example, from China Merchants Bank, which had a very strong profit report driven by strong loans growth. Do you look at the strong loans growth on the mainland as perhaps worrying down the track rather than good news now?
Yeah, the CMB has kicked off the new release of the earnings of the first half of 2007 of all the other Chinese banks, and I'm really positive about the earnings about that sectors, because the banking sectors in China is really isolated from the global markets, and they are supported by the government to help them to provide more chance to do the reform, and the retail sectors is really strong, which on the other hand to support the CMB, that kind of a strong retail banking sectors. And I think the loan growth in the second half in 2007 will be under 15%, which is the target from the PBOC. But the loan growth is kind of be moderated due to the interest hike. But the banking sector will still make some money, because I can see a gradual shift from the loan growth to the bond market since the banking sectors, they are really concerned, they are beginning to concern the quality of the expansion of the loan and the mortgage in China real estate sectors. I think the momentum is still strong, but not so strong compared to the first half year in 2007.
Gong Liang,
Hi.
So far China's been pretty insulated from this liquidity crunch, so to speak. However, we were talking to Arjuna Mahendran earlier this morning on Squawk Box. He's at Credit Suisse, talking about he believes that this subprime crisis could lop maybe about a percentage point off growth in the third quarter for the U.S. How might that affect, if not significant, how might that significantly affect the Chinese economy going forward if the U.S. economy slows down considerably from this crisis?
The slowing down of the United States economy will impact the Chinese export sectors, and due to the underperformance of the U.S. dollar, I think the export to from China to the United States will deter some percentage of Chinese exporters' contribution to the GDP. But I don't think the slowing down of the United States will really impact the strong growth of China, because China now does not only rely on the United States, but on Euro, on the South Africa, or some other regions. They are trying to reposition themselves internally to boost the retail sectors. But I think that the main problem for China government now is not the export, but the inflation crisis. I think the inflation number will go up by over 5% in July, maybe will curb some investment, and another interest rate hike is possible.
Indeed, China obviously has huge, vast reserves of exposure to the US dollar through its holdings of USTs. And can I get your take, Gong Liang, on the fear that was sparked by a Daily Telegraph report this week that China could use its USTs as a political weapon, that it may liquidate or sell its USTs if indeed Washington decided to get really tough with China and impose trade sanctions to force a revaluation of the Chinese yuan? Would that be economic suicide for both parties?
As far as I know, the telegram from that news is not official, because the government has not said anything about that. I don't think China will take this option to sell a lot of U.S. treasuries to go to other sectors to buy the more high profitable bonds or the other products because they currently they don't want to hurt the relationship of the United States and China, and they don't have the talents unless the United States will adopt a massive attack on the, for example, 25% tariff on all Chinese goods. Then China may probably adopt that to fight back. But I don't think it's going to be happen in the near future because the U.S. Treasury bond is still a very safe and a good cushion for the tension between China and the United States.
Indeed, we saw a huge flight to safety last night as people bought USTs. Gong Liang, thank you very much for your comments. We're Gong Liang, credit analyst at CFC Seymour, and we'll also get back to Ben Pedley after this quick break.